Here we go. Started the first version, the first podcast recording,
All right.
the market update.
Perfect.
Yeah. What did the market actually do today? What did it finish at?
It was up a bit. Yields were down. I mean, not yields were down. Yields were up. Yields were up. Market was up. So
Yeah.
bonds, not the best day. Good day for stocks, relatively speaking.
Did you happen to see, we were on the call with those advisors this morning, and we keep calling for the rotation into, I guess, anything but the Mag 7. I feel like it's eventually going to happen, but
Yeah.
did some of that happen today or not?
Well, let's take a look here. Tell you what. Let me gonna open this up. There's a way I can here. It's loading for me. Okay, perfect. Here. Let's take a look at this. I've got a heat map here in Y charts that I take a look at throughout the day, just keeping an eye on markets as a whole.
Yeah.
But this is a neat one here. And basically, what it does is it scales the companies listed in the S&P 500 by their market cap, and then lists their return. So we can also have it do it by price. But yeah, it looks like. Let's go back to market cap. I like that. Anyways, looks like for the most part, positive. Apple, I know, had a negative day. They had some news today, and I just want to make sure.
Yeah.
That seems steep for Nvidia, but who knows?
I feel like
Yeah,
those companies are just so expensive.
very
Like,
pricey.
I mean, what's Nvidia? What's their, they're up a 1.25% today, basically.
Yep.
When you look at some of these price to earnings ratios on these companies, whether it be just pick any of the Mag 7 or pick the S&P 500, the market cap weighted version of the S&P 500. I mean, they're just so expensive comparatively speaking. I mean, that was one of those things we did recently. We when we allocated, we'd been at 70/30 in the weighting between US stocks and international stocks, which a heavy part of that is US large cap, right?
Yep.
And US large cap, the top part of the market cap weighted indices and the top part of, I would say, most people, or at least a lot of people's portfolios, it's just so expensive. Um, we rotated away from that. I mean, but I mean, the 30-year average forward PE for the S&P is like 17, and we're at 22 plus at the moment, right? 12, maybe even bordering on 23 now. I haven't looked at it in a little bit, but I mean, it just feels really expensive. And then you have the, like, last week the jobs data comes out, pretty lackluster. Um, I don't know. There's so much conflicting information out there, but it's just when you look at stuff, it feels expensive to pay for these stocks at these ratios from my perspective. So I feel like we have to get to a point eventually where the rest of the market, like meaning international stocks, value stocks, smaller market cap stocks, both mid cap and small cap stocks, actually have their day in the sun, but they haven't had it for a long time.
Yeah, it's definitely been a bit. Um, I mean, additionally, we talk about how important it is to be diversified and how concentrated the S&P 500 is. There's a lot of articles coming out about that right now, just discussing how concentrated the S&P 500 is. And that's the other thing too that you notice. Aside from these companies, they performed very well over the past couple of years. But also, just like this is a great graphical or just good presentation of showing people just how concentrated the S&P 500 is. I mean, this is really scaled to size. So if you
Yeah.
own SPY, you're owning companies in this ratio, which is just an interesting thing to take note of, because someone buying the SPY ETF is expecting it to be broadly diversified, and it's just gotten less and less diversified as these
Yeah.
positions have become more and more concentrated in there. So, uh, yeah, just an interesting thing to note.
Yeah. I don't know. I mean, that's what I feel like we try to do what we would do in our own portfolios and client portfolios. And that's what, I mean, for me personally, it's been buying international, buying cheaper stocks, and it's not like, I look at those companies like Nvidia. It's not like I all of a sudden think Nvidia, Apple, Microsoft, Amazon are gonna, capitulate. I really don't feel like that's the case. That would be really surprising to me. Especially if we don't go into a recession. I mean, I just feel like the rest of the market has to catch up at some point, maybe more than the top of the market cap capitulating, the top Mag 7 capitulating. I just don't think that that's necessarily likely. I mean, where can you get I mean, for example, everyone talks about Nvidia, so we might as well just talk about it. Um, but like, where do you get the earnings growth that Nvidia has had?
Oh,
You know, I mean,
yeah,
what's their earnings? What was their
high,
earnings
high
growth
double
last quarter?
digits, way up there.
Yeah. I mean, if I remember correctly, I mean, they disappoint, slightly, but they still have double digit earnings growth. And that their stock price sells off a little bit. But at the end of the day, like, I mean, where else can you get that? I just think they're fairly valued at a minimum, you know? Um, so the rest of the market eventually, you would think, has to catch up a bit and have their day in the sun.
Yeah, I mean, absolutely. Um, And I think that's the big thing to talk about. We had that report come out recently, or should be coming out soon, where we're taking a look at the PE multiples of major indexes in the U.S. Growth, value, S&P 500. And when we say that the S&P 500 is elevated, or something like Nvidia is elevated, there's two alternatives: either the price comes down into a range that we would expect, or we just have to wait for earnings to catch up, so
Right.
the denominator can grow too. So potentially we continue to see that great growth and everything like that, but maybe the price doesn't move as much because a lot of that's baked in. Um, so again, kind of going off what you said there, doesn't necessarily mean that we have to have a horrible correction or anything like that. Just might lag while other things outperform.
Yeah, yeah, I agree. I feel like that's potentially the more likely scenario than anything else, unless something major changes that is some catalyst. Which again, that's what nobody knows when that's coming. But I mean, I just feel like that's more likely scenario at this point. But I don't know. It's an interesting time. I feel like an idiot sometimes when I jump on those calls on a call with an advisor, and I feel like a broken record, and I'm just saying some of the same things, but there's some things that are just they just make sense to me, and that's one of them. So I don't know. We'll keep
Absolutely.
keep plugging along. And again, that's one of those things why I'm not saying that everyone should just be. It's not like I want to go out and short Nvidia. That's the last thing I want to do. It's a good way to lose a lot of money.
Yeah.
But yeah, anyways, I don't know. The other interesting thing, like from an economic perspective, again, it's just kind of illustrating the point that there's, a lot of uncertainty out there, kind of conflicting inputs. Like we had a pretty weak jobs data last week.
Yeah.
And that obviously is indicative of a slowing economy, right? But we've had, inflation's obviously come down from where it was, almost 10% 2022, but it's obviously come down from there. But there's still there's been some hot inflation the last, at least some reports that have surprised people a little bit recently. And if you look, I think the more interesting thing in inflation is if you look at what's driven a lot of the inflation, it's spending on hospitality, spending on luxury goods, things that you would not think are indicative of a recession. So you got one side of the fence, like potentially slowing economy, poor, jobs report. I mean, exceptionally weak jobs report last week. And then
Yeah.
you got the other side of the fence is inflation's being driven up by luxury goods and hospitality and things that you would assume people are only spending money on if they have expendable income and they're doing great. It's more that side of the fence is more indicative of a recovering economy than a sputtering economy. So I don't, you look at that, and that's one of those reasons why I mean, it's so silly when people try to, in my opinion, try to time the market too much because it's never just clear
No.
cut. That's why again, like I don't think that I'd advocate for, shorting Nvidia and Microsoft and all the, all those Mag 7 names. Like that seems like a silly approach as well. It's just you have to come up with the right balance. And like I said, I guess at the moment we're over allocating a little bit to international. I wouldn't even call it over allocating. We're just a neutral weight to international, kind of overweighting some value in the portfolios just because they're cheaper, but it's hard to just commit and say, well, let's go short, Nvidia or something like that. It sounds like and it is kind of a crazy thing to do. But when you look at it, the reason being is there's a lot of conflicting information out there. Like you can't ignore things like that. But it's easy to find what you're looking for when you you know, it's like one of those things. Everything's a nail when you have a hammer.
Yep.
So I don't know.
Absolutely. Yeah. Um, Especially, I think the big thing we've talked about this a lot with Nvidia, but just how concentrated their client base is and how reliant on the other members of the Mag 7 they are for their revenue.
Yeah.
So you start to see weakness in any one of those players, and you see that bleed through. And again, this isn't recommending to sell off Nvidia or anything like that. Just relatively speaking, we're looking at the whole market and seeing, hey, some of these companies are a little less loved right now, potentially poised for, at the very least, less downside, potentially more upside.
Yeah.
Um, but yeah, Nvidia
Yeah.
is definitely an interesting one.
Yeah, I agree. Definitely an interesting one. All those Mag 7 are interesting ones. And again, great companies.
Yeah,
It just can be a little expensive relative to the rest, especially when you have other options that are cheaper. I was looking at I don't remember the exact numbers on this, but the healthcare space as a whole has been so beat up recently, right? But there are something like 60 plus companies in the S&P 500 that generate um, that have basically a market cap nearly equivalent to Nvidia, slightly more, right? But it's like 60 some companies, and they generate many multiples of the revenue that Nvidia generates. And it's just kind of indicative of, again, like, would you rather own, an overweight to those 60 some companies that generate more, equivalent revenue, but at a much cheaper cost or
yeah,
more revenue, or buy the one company that's trading at an astronomical number? And again, if the earnings growth continues, I mean, maybe it's justified, right? But
yeah,
I think they're likely in a position that, like you said, maybe they don't sell off drastically, but there's other opportunities out there when like the whole healthcare space is trading at such a discount relative to some of these other names.
yeah, absolutely. Absolutely. And I mean, that's the other thing too. You hear about it on the news a lot, but AI is a huge revolution, kind of like we saw with the internet, early 2000s, and just seeing that bleed through to company productivity, that sort of thing. Uh, but in addition to just AI, these companies specifically specializing in AI almost directly, with NVIDIA doing chips that are mainly dealing with AI. The other thing too is, so what about the secondary products that we need to scale that sort of thing up? So like energy production, those utility companies, and again, hear about that a lot on the news, but and some of those have started to rally for sure, but certainly we haven't seen the returns that we saw from Nvidia or something like that. So
No.
um, there's a lot of stuff tied to that AI space as a whole, and just
Yeah. not just a
Seems to
couple
be
names.
localized.
Yeah. Yeah. It's been localized in the market returns, but it's not just a couple companies that are the rock stars
No.
long term. Yeah. Not if it's a really durable, which I think it is. Not if it's
Yeah.
really durable. Yeah. So, anyways, you have to changing topics here just quickly. You have to could you walk me through the research you did on gold recently? I was
Oh yeah.
interested in that myself.
Yeah, absolutely. I mean, so at a broader level, recently we've seen gold rally pretty strongly, and again, we can see that from a few things. We see weakness in the dollar, but we're also seeing weakness in currencies abroad. Most major economies are also having, uh, you know, concerns about debt. Maybe not the same that we have in the U.S., but Europe, even Asia, they're also having these come to grasp of reality with how much debt's being taken on, and that bleeds through to currency risk in a number of ways. But basically, what I saw, I was watching the news one morning, and they were talking about how well gold is done, particularly on the year to date. And so, we know that gold can be pretty volatile, uh, but at least in a textbook sense, a lot of people talk of gold as a hedge and really not much of a return driver over time. And that's the way I understood it. I mean, when you were doing the CFA reading, that's a lot of the way they present it in a textbook sense, because over the past 100 years or so, I guess gold is really going to give you some solid returns about in line with inflation, 3 to 5%. Um, and that's usually the way it's presented, not necessarily a great place to put your money for a long period of time, unless you're, specifically hedging inflation or, making a short-term bet, right?
Right.
Um, and really what, I just out of curiosity, I pulled in for a proxy for gold, just brought in, there is IAU, is the ETF that
Yeah.
marks gold. And what you look at, if you look at the return of gold versus the S&P 500 since 2005, gold has outpaced the S&P 500 over that same time period. And I've got this chart pulled up here. And it's not by an unsubstantial amount,
Yeah.
in the slightest. So that's kind of just the interesting thing that I've seen with gold. Now, when you back it out and you just look at gold as a whole, and obviously the ETF IAU was only has an inception date of 2005. But if you look back further and you just look at the commodity return, S&P outpaces it over that longer time period. But over the past 20 years, gold has been a great place to be, and even better than the S&P 500 if you just bought it in 2005 and held it until now. So that's an interesting thing. You and I were talking about this, and we haven't really gotten to do the in-depth study on this, but one of the things that I was interested in looking into, and you as well, was the impacts of QE, introducing QE into monetary policy, specifically within the U.S. in 2008, and how that impacted gold's return in the coming years. I mean,
Yeah.
additionally, well, we see 2008 gold obviously takes off, flight to safety. But then we just had really low rates in the US. It's been a good safe haven asset for a while now, and it's just performed well. So definitely some interesting research to do there. But yeah, interesting thing to take note of, just because at least from what I knew, the textbook definitions of gold and what we would expect from gold, this is not necessarily the behavior that I would expect.
Yeah, it's interesting. We definitely got to dig into that a little bit more. I mean, it makes sense. That would be my, it makes sense as you have QE, you are devaluing your dollar, your value, you're pumping up the value of this kind of for a currency, basically. I guess it's not really used as a currency anymore, but you're pumping up the value. I mean, it makes a lot of sense. I don't know. A lot of people are big proponents of gold. So would you buy, Nick, would you buy gold and put it in your safe, or would you buy IAU?
I don't know. I guess it really depends on what the purpose is. If you really have some apocalyptic expectations, then I suppose you need to have gold in a safe, but then you've got some other concerns to have. So,
Yeah.
I don't know. I prefer it in liquid form, or the most liquid form that I can, so that I can get in and out of it.
Yeah.
Because I guess if you really see it as a flight to safety or just a safer asset, um, liquidity is important. So
Yeah.
I tend to like the ETF. That being said, if you want to put the tinfoil hat on, I think you probably need to get the gold in the safe.
Yeah. Well, I feel like for me, if I'm trying to answer this for myself, like if you're trading in and out of it and hedging it, the the liquidity is nice.
Yeah,
You can put it in your retirement accounts. I guess there's probably ways through these gold companies to buy it with your IRA, but I mean a little sketchy some of them. But I mean IAU is super easy, right? You can just
yeah,
dump that in your IRA, your Roth, whatever, no problem, right? Um, and you can trade in and out of it really easily. So like I think I would answer the same way that you answered in a case where I was speculating. But yeah, if you wanted to, I mean, there is a case for having some gold as a hedge just in your
yeah,
safe, uh, hedging, I mean, I know there are a ton of clients that I know do that. Either
yeah.
gold bars, gold coins. I mean, you get any precious, any jewelry, anything that you can store gold in. I mean, it's not necessarily a bad thing. And if that person just wanted to hold it indefinitely, then yeah, go buy it, put it in your safe if you're not going to trade in and out of it. I mean, the funny thing is though, it is pretty liquid. It's still, even if
Yeah,
it's in your safe, it's pretty liquid. You got to make a little bit of effort to go take that gold from your safe and, you know, get the cash for it. But I mean, it's still pretty. That's the nice thing about some of the alternative assets. You know, real estate not the case,
yeah,
but collectibles, gold, jewelry, things like that, they're still pretty liquid. Like you can get cash for those pretty quickly.
absolutely.
So I
It
don't
would
know.
be interesting to run an experiment of that over a few years, and maybe we need to do it. But
Yeah.
would be the price return over 5 years of holding an index or an ETF like IAU, or buying physical gold and then taking it to a pawn shop, or someplace that does
Yeah.
gold trading or whatever. Because I'd imagine the spread would be a little bit higher on physical gold. Usually they take them, but maybe not. Maybe not. Maybe that's not always the case. But that would be my only hesitation with it. But it would be an interesting experiment.
Yeah. I would play that bet with you.
But yeah,
We should do that. We should take
let's
whatever
do it.
like the price of 1 ounce is,
Yeah.
whatever it is, like $3,000 an ounce or something. I'll go buy 1 ounce of physical
Okay.
gold and put it in my safe for 5 years, and you buy
Let's do
the
it.
equivalent in IAU.
Let's do it.
That'd be
Yeah.
a fun
At the very
experiment.
least, Oh, and I didn't mean to cut you off there, but at the very least, it's a great hedge for part of your portfolio. Taking a step back, looking at the correlation of the returns with the S&P 500, very low correlations
Yeah.
over a long time horizon, almost zero. I have that correlation group in Y charts, taking a look at that. So you get a number of benefits from diversifying with that. Not only not sacrificing too much return, but additionally, just capturing low correlation. So in
Hmm.
addition to stocks, 5%, 10% of your portfolio just as an alternative allocation. And again, getting alternative exposure, like we've talked, it's pretty expensive to get alternative exposure sometimes.
Yeah.
Um, you're
Cheap
paying a
way to
lot
do
for
it.
that lack of correlation. So uh, gold definitely could be a great part of that for diversifying client portfolios.
Yeah. So last question for you on that. We've never actually included gold as part of one of our diversified out of the box portfolios, but if we did, we typically have fixed income sleeves and equity sleeves that we mix together to create a 60/40 or 70/30 portfolio. Would you include it as a hedge and would you include it as a part of the equity portfolio and look at it as an equity hedge? B, as part of the fixed income portfolio as an inflation hedge, like almost like instead of using tips.
Yeah.
or in addition to using tips, or would you just consider it a completely separate asset class and it's as unrelated? It's like a third sleeve.
I feel like in my mind it's a third sleeve, but if I had to group it, I'd put it in fixed income.
Yeah.
Again, for the reasons that you mentioned. But and that's the other great thing too. Usually, a lot of assets that have a high or a low correlation with equities have a higher correlation with fixed income, and that's also just not the case with gold. Um, so, in my mind, just categorizing it from a statistical perspective, not just looking at the fundamentals of the asset, definitely seems like a true alternative to me. Uh,
Yeah,
but I
I,
guess if I
I
had to
agree.
group it, fixed income.
Yeah, it's a tricky one. I agree with you. In my opinion, it's clearly a different asset class, neither fixed income or equity. But if you had to bucket it into one, I mean, it has a volatility profile more like equity, I guess, and return profile more like equity, but low correlation there. Low correlation to fixed income too, though. Um, I feel like including it in a fixed income portfolio would not be out of line though. Like for a pure fixed income investor, if you were trying to hedge, if you're trying to hedge inflation, hedge the risk of lots of QE, low interest rates, like we've been in since 2008. I mean, your analysis there puts it out there pretty nicely. That's
Yeah,
a nice hedge. I mean, fixed income is rough during periods of time like that, or can be rough during periods of time like that, where you have a falling rate and just a where you have QE going on basically, where you have
yeah,
lots of government spending, increasing inflation, a low interest rate environment. It's you know, difficult. So it's a nice way to hedge within the fixed income portfolio, in my opinion. So
absolutely, absolutely.
we'll see.
Yeah, I think a last little comment on that. Just what we've seen recently with gold. Um, Again, we've seen relative weakness in the dollar. Dollar's been weakening a bit. Um, and like I said, there's also currency concerns abroad as well. So there's not necessarily like one safe haven currency that everyone's flooding towards.
Right.
So we see global demand for gold coming from currency concerns, just because it's a nice place to park your assets, regardless of which country you're in.
Right.
Uh, so it's an interesting one. Now, I think the question would be with Bitcoin being considered digital gold, would you group Bitcoin in with the fixed income allocation if you had to put it between equity or fixed income? Which one's it
Yeah.
going in for you?
I feel like it's got to be an equity.
Yeah.
I can't imagine, if you were thinking about an all fixed income investor and you're explaining to them how you put gold in their portfolio to hedge against, you know, all the stuff we're talking about here, right? Um, hedge against inflation and all that stuff. I think that I can make that argument. But if I said I'm also putting Bitcoin in your portfolio, I just can't get my mind around doing that. So it's got to be equity. But I do think it's a third asset class as well. I don't like for me personally, it's got to be a third asset class. It's not or another asset class. It's just not the same. But I don't
Yeah.
know. What do
I
you think?
No, I agree, and it's kind of the funny thing with Bitcoin. Uh, it's a risk-on asset. Typically, it behaves as a risk-on asset. Gold's a risk-off asset. So I think that would be like my initial justification for one goes fixed income, one goes equity. But maybe it's because we're at the early stages of the adoption of Bitcoin, because essentially like it's really designed to behave like gold, a limited supply. Um,
Right.
not going to be interfered with by central governments, central banks, interfering with the mechanics of the structure of Bitcoin. So maybe it's because we're in the early adoption phase and we're still like ramping up, and it's still seen as this risk on asset. But um, I guess the end goal, or I guess a lot of what the founder of Bitcoin was looking for was a digital gold. So maybe we'll see it creep into the fixed income allocation over time.
Maybe, yeah. Yeah, ask in 10 years. I think you're right. Like that's at the moment, Bitcoin is so volatile. It's known so much as a risk on asset and a volatile asset, all cryptocurrencies. So will that change over time? I think it has to change over time for Bitcoin to fully its potential to be fully realized. I mean, how can you, it's very hard to store, in my opinion, very hard to store value in something that is as volatile as it is, and actually transact with it. If you're going to go to Drug Mart and buy, milk and eggs and bread, like who would, how can you be using Bitcoin to transact and thinking to yourself, well, it might be worth 20% less than it was last week or 20% more. It's just a hard, I feel like, and I mean, there's a lot of, the adoption of stable coins and whatnot to use the advancing technology in a way that facilitates that. But Bitcoin itself, Ethereum itself, there, I mean, it's a tricky. Yeah, I wonder how that will change. It'll be interesting to see how that changes over the next decade as it becomes more and more adopted by individuals and institutions to actually sit as a store of value. Well, right now, I think we'd clearly set it on the side of more like equity. But in 10 years from now, will we set it on the other side as a more conservative asset, more like gold that is maybe considered a store of value that's not so
Yeah,
volatile.
absolutely. I definitely see the use case there, just given the mechanics of it. It's just in practice, it's very volatile. I found it really interesting when, was it Ferrari that said you could buy a Ferrari in Bitcoin,
I
right?
think you're right. Yeah.
Was it Ferrari or Lamborghini? But I always thought that was interesting because, it's not uncommon for Bitcoin to have like a $5,000 move in a day,
Yeah.
$10,000 move in a day. So you start driving to the Ferrari dealer to buy your Ferrari, and by the time you get there, you can't afford it, just because it's moved so much.
Yeah.
And I'd imagine that they peg their price to the dollar. I doubt it's like 2 Bitcoins for
Yeah.
whatever, but
Right.
um, yeah, the use case is definitely there. I don't doubt that it's coming just right now.
Yeah. Maybe it will be in the future. Yeah. I don't know. It'd be interesting because you're right. It's all pegged to the dollar. So you're either you could get there and not be able to afford it, or you could maybe afford to.
Yeah.
Yeah.
Who knows? But yeah, no,
Yeah.
get a little sidetracked there. But
No, sounds good. Well, I think I mean that's all I had. We're gonna do these what weekly going
yep.
forward. Every Tuesday we're gonna record these. So this is our first one in the reviser uh market update, market commentary. We'll come up with a better name for it as we move along, but I didn't have anything else. Did you have anything else, Nick?
No, I mean, I think the only last little piece that's probably more relevant that we probably want to cover this week is expectation for rate cuts and the, how that's going to impact the markets really quickly.
Yeah. Well, I think it's very likely that we have rate cuts, by the
Yep.
way. That I mean that I think that's almost, I don't want to say guaranteed, but pretty solidly guaranteed after the jobs report. It'll be interesting. I mean, that's the place where I feel like we're watching most now. We've made our equity portfolio adjustments recently, and now it's watching fixed income and seeing how we want to adjust, which is really dictated by the Fed path going forward. So I like where, we're now on average about 1 year past our benchmark in duration, and I think that's a good place where we want to be. um, we could adjust that going forward, but we've been trying to be positioned there preemptively. And it's been good for us thus far this year. We've had a falling rate environment, so our bond uh, portfolios have done well as the prices have increased. And I think that depending on how aggressive the Fed acts the end part of this year and the beginning part of 2026, hopefully we continue to benefit from that. It's one of those things you got to be positioned properly first. So that's been our thesis all year. I hope and starting to get to the point where we've already experienced some of it, right? Just the expectation and the several rate cuts that have already happened have been benefits for us. Hopefully that continues, but definitely that's the place where I feel like we're watching the most closely now and have the most potential future adjustments are in the fixed income portfolio to tweak the duration target, especially as we go throughout the last part of this year.
Absolutely.
Sounds good. Well, is that a wrap for our first one?
I think that'll do it.
All right. Sounds good.